go to where the opportunities are. Our marketplace is nationwide. The notes are backed by a security agreement. The security agreement's what binds that payback to the properties. We're totally good in a good market, but in a bad market, that's where we can buy these non-performing assets and help people stay in their homes. You see, the goal is not to foreclose on people, it's to give them a second chance. So we help people stay in their homes, because if we buy them cheap enough, we can do what banks cannot do or are not willing to do, which is work with people. Well, it's a pleasure to host your Wealth Wednesday. Always exciting to be in front of a group, whether it's live or over Zoom today. I've got a lot of great things to share with you. As Shauna was saying, some of you may have seen me at the 3 days. Some of you may not have yet, but I assure you, every time I do a presentation for Chris's group, it's always something new, a new focus on this industry that I specialize in, which is the cash flow on real estate assets. So we'll be taking a deep dive into that. I'll be going over the math for you. I'll talk about sources, returns, and I always like to teach things through a format that most people absorb better and understand better and can relate better, because it's all based around case studies. It's actual things that people have done. So it's not theory, it's actual results of what people have been able to do by pursuing this particular industry. But before I get into all of that, again, a pleasure hosting here, because I've been in and around Chris, all the different Chris's companies and such for quite some time now. When I started to look back on it, I was like, boy, I've been to now 3 of the experiences. So I went to the one in Mexico, went to Las Vegas, the one here most currently in Orlando, and got to meet a lot of people through those. And those are always a lot of fun and great networking opportunities. I don't know how many presentations I've done at the time. I even did some live presentations up in Buffalo early on at the old office. And that's where I met Shauna, because I had met Chris and I had met Steven out at an event that I invited them to. In fact, what I did was I invited Brett Kessler out to an event, and he was going to fly out, and he got double booked. And he said, "Oh, don't worry. I'm going to send somebody. You're going to love him. He's going to do a great job." And that was Chris Naugle. So this was all pre-COVID that we first met, got along very, very well. And Stephen was there, and we all just hit it off. And I think because we have a lot of the same philosophies. I mean, it's great to work with people who really do care about the success that people gain from what they're teaching. They want to help people as much as they possibly can. And there's a personal touch to it. And I think that's a very, very attractive thing to see in the training industry. And I'm a big proponent of that as well. And I think that's one of the big reasons why we all get along so well. There's that common pursuit of really giving back and what can we do to help people. So I'm sure that will resonate with you all today. And then it's really a matter of with all the various opportunities that you're presented with as being a part of this organization and Private Money Club and some of the other entities that they have is looking at what do you resonate the best with? What pursuits do you see as to working out? Because there's a lot of great opportunities here. And I think as I go through this with you today, that you're going to see a really good opportunity that has grown from a true niche in the real estate industry to really its own asset class. And it's been really, really interesting to see that growth, because it didn't happen overnight. It's happened over a 30+ year trajectory. And today it really is something that should be a part of everybody's investment portfolio. And I'm going to lay that case out for you today, utilizing real case studies, but there's going to be a theme through on this. I'm going to try to answer as many questions that I think you would have as we go through this process in context already. You're always welcome to add questions to the Q&A for sure. And I will do, as I said, my best to monitor that as I'm going through the presentation. I'll probably get to a point where I'll stop, check, and then we'll move on. But I'm going to use real deals, real numbers. I'm going to switch from PowerPoint to calculator to spreadsheets, because I want to show you really how this business works. And if it's an investment of something that you're interested in, I work with a lot of people from these organizations, that Chris has, and Be Your Own Bank, and all these wonderful entities, private lending club and such. And I work with a lot of folks, and again, dedicate a enormous amount of time and effort to make sure that they're getting the results that I know that they can get in this industry. So you've got my contact information and such on there as well. I'll probably post that later on in case you missed that. But I have been a specialist in this particular part of the industry for quite some time, but I'm not one of these investors who just has blinders on and says, this is the only thing everybody should do. I actually have a very diverse background in real estate. Real estate was always a passion of mine. Graduating high school, that's what I wanted to get into. After I graduated college, I became a commercial real estate appraiser. I got into real estate sales. I got into real estate investing. So it's always been something that I've been attracted to, and I've had some very good success. I've definitely run into my share of failures in real estate crashes and such, but learn from those, and that's the key. You learn from what doesn't work. You prepare yourself better for the future. So most people who have a career in real estate have a similar story when it comes to those sorts of things. But I started real estate investing and buying real property, and initially, early on in my career, it was challenging, right? And a lot of people who start new into real estate, it's tough. And a path that a lot of people take is starting by wholesaling real estate, that sort of thing, finding deals, put them together. And again, you can make money doing that, but you're only as good as your next deal, right? And it's constant. So it's a tough way to go in the business. So I got into a different side of the business, the debt side of the business, which is going to be our main focus here. But before I get into that, as far as just true traditional real estate, I've done well over 150 rehab properties, found them, got them financed, fixed them up, sold them, did a lot of that. I've done landlording. I've been a money lender. I put together a fund and lent money. So I have an extensive background in a lot of these areas of real estate. And I started early on in the note space, which I'll come back and define for everybody who's still a little sketchy on exactly what that is. But I got away from it for a little bit and I came back in. And I think when I lay out this presentation for you today, I think a lot of you will agree with me where I say it should be a part of anybody who's certainly involved in real estate, because this is just the financial side of real estate. But also, I think you're going to find it should be a part of any investor. It's another way to diversify your portfolio by building these long cash flow returns that you can get. And you can see I wrote a #1 bestseller on the book, and I also contribute to the newsletter that you can see on the other side of your screen. But I want to lay out why I really focus on notes in a way I think that everybody can understand. Now, you might relate to this directly, you might relate to this indirectly, but this was my list of looking at all investment opportunities. I simply came to this conclusion. I said, okay, why notes? Why would somebody want to be in this business? Why did I want to be in this business? With all my other experience with real estate and all the other things that I did, why notes? Well, my answer came from this. I put together a list, and it basically goes just like this. I don't want to go out and look at property anymore. Now, again, that's just me. Some of you may love to go out, look at property, walk through properties. I've done a ton of that. Like I said, I bought over 150 rehabs. I walked through a lot of properties in all conditions and everything else. And I think I just got burnt out on that. So it's like, I'm done with that. I don't want to go out and do that sort of thing anymore. I don't want to bid at live auctions. Live auctions can be really, really tough. And if you've never been to one, I encourage you to go at least once. And you'll see very quickly, I've been to probably 6 different auctions in different states, and it all works the same way. There's a group of people that's where they make their living, and they will do anything they can to keep you out of that space. They don't want direct competition coming in. And it gets very challenging at those auctions to start. Don't want to do that anymore. I don't want to take a lot of debt on. Now, again, I fully and appreciate and understand how debt works. And sure, if you can borrow one thing, make a higher return, utilizing debt is a great way to go. But you have to be careful. We all have to admit that when markets change, you don't want to get caught. And that's what can happen. In the last crash, that's what caught me. I had properties, I had money out that I was lending to people who were rehabbing properties. All of a sudden, the market tanked and I got those things back. I had a bunch of defaulted debt. I had some debt myself. So you do have to be very careful and monitor the market as you do that. But at some point in time, if there's an alternative, my thought is, if I don't have to go into a lot of debt and I can still make my goal, which is passive monthly income, then why wouldn't I pursue that rather than going into a lot of debt and buying an expensive asset there? I don't want to deal with contractors and handymen. Look, again, nothing wrong. I've worked with a lot of contractors and handymen. No problem at all. But at some point in time, look, it's like anything else. There's going to be great ones. There's going to be ones that aren't so great, we'll say. And it's just a tough thing to do. And I understand that when you hire those folks, especially for those in the rehab side of the business, they have to give you an estimate. And it is an estimate because they don't know, especially here in Florida. I'm in Florida. We have termites. Okay. It's just, that's how it is. Right. And they just don't know sometimes when they're making a bid until they open that wall, they take the drywall down, and now they see another problem. Now your expenses go up, and the problem is so many people in real estate don't really understand that budgeting. And boy, one big thing on a rehab all of a sudden changes their numbers pretty dynamically. In fact, one of the notes that we're seeing now is investors who are renovating property are starting to default more. We hadn't seen that in the past. So it's a trend we're starting to see in our industry right now because we buy the debt on property. And this debt's going non-performing. Why? Because a lot of the rehabbers are finding out that costs are going up, lumber, labor, all that stuff is going up, but their profit margins are being cut down. Property values are maintaining. They're not going up in all places, although they are in some they're actually going down in, and it's becoming more challenging on that side of it. But I was just done with that. I don't want to do that sort of stuff anymore. I don't want to deal with tenants. I've been there, done that as well. A great way to make a living, build up a bunch of rental properties. I get it, but it's not for me anymore. I don't want to deal with tenants anymore. And you know what? I don't want to work hard. We have all this wonderful technology that we can utilize today. And now we've got the advent of AI to help with other things. It's like, why do we need to work hard? Going out and looking and walking through properties and estimating, putting all these things together. I want to work smarter, not harder. I don't want to have to spend a bunch of money to market to find deals. Where do I find these things? How do I do that? What kind of software programs do I need to buy? I just don't want to do that. And again, if you're thinking a different way, that's fine. I'm just saying this is my take on these things. But I do want some things, right? And one of them is passive income. I think everybody's attracted to passive income. When you can do something one time and then have it make money for you over and over and over again, obviously there's an attraction to that. That's what you can do in this business. Now, there's short-term passive income and there's long-term passive income. We're going to be focused on both of those today. I do want low risk. We're in a market right now that, again, depending upon what experts you read about or read from or listen to on any given day, where's the economy on? Nobody seems to know. It's good, it's bad. It depends who you listen to, but obviously if you're listening to Chris Naugle's group, to Chris on his videos and such, there's definitely cracks, right? So there is, in your mind, you should be thinking, hey, things could go bad here. Okay, in the future here. So we've got to be prepared for that. And you have to look at risk on all these investments. One of the things I've noticed about some investors, whether it's traditional real estate or notes, they start yield hunting. What's my return? That's the first thing out of somebody's mouth. It's like, boy, you really need to stop and put that question, further down the line. Your first thing is, what's the risk? What's the risk involved with doing this? That's where you can get wiped out. Your returns can fluctuate. Your returns can change, but you want to have a return, with a plus sign on it, not a negative sign on it. So you absolutely want to look and identify risk. I'm at that point where I want lower risk, but I still do want a high return. Is that possible? Yes, it is. I do want to create income. I do want to create wealth. There's a difference, obviously, between those two things. Somebody making a very good income doesn't necessarily mean they're wealthy. They could just be broke on a higher level. And there's a lot of folks that fall into that category. They're not building wealth. So ideally, if we can build something that does both, that suits me well, probably suits you well also, and the note business can deliver that as well. And I wanted something where I could travel. I could be wherever I wanted. And gosh, with Starlink satellites today, you literally can do that. And as long as you have access to a computer and the internet, you can do this business. That's attractive. You know, I like being able to do that. And as I was mentioning before, I want something that works not only in a good economy, because that's when things are easy, right? Nice and easy. Everybody's making money. Look, when property values were going through the roof back in the early 2000s, everybody was making money. You could make big mistakes and still make money because property values were appreciating so much. And oh, everybody had a good time until the market corrected. And then you found out really what was going on. So if an economy goes bad, how insulated are you? Is your portfolio at risk? And what's interesting about the note business is our business actually gets better in a bad economy. Now, I don't wish a bad economy on anyone. We're doing great in the note business on a good economy, but if it does go bad, it's actually better for us, okay, in a strange way. So I'll explain that more as we go through this. So you take this and then you combine it with one of my favorite quotes. Now, whether you care for Robert Kiyosaki and his philosophy on wealth and everything else or not, that aside, the power of this quote, I think, is pretty obvious to everyone. To obtain financial freedom, which I think is the goal of everyone listening and watching this right now, one must be either a business owner, an investor, or both, generating passive income, particularly on a monthly basis. That is really the definition of the note business. It's a business, but we're investors within that business, and it's generating passive monthly income without dealing with the tenants and the toilets and all those other things that come with it. That's why my book is called Real Estate Without Renters. Okay. Again, nothing wrong with building up rental property. I'm not one of those people again who goes, oh, you shouldn't do that. Sure, you could do that. Just understand what comes with it. But you also might want to diversify or shift your focus. I've got a lot of former landlords that now become lien lords, as we call them in the industry. They're no longer a landlord, they're a lien lord. They just have a lien on a property. They have a claim. Don't call me now with the roof is leaking. You own the property. I just get the cash flow like the landlord without all the baggage that comes with it. Very attractive to real estate investors here. So that's our focus on this. It's called the note business and the paper business as it's known. So let me break that down to exactly what that means, because we probably have some people that this is a very new concept to. I don't buy real estate itself anymore. I buy the debt on the real estate. Well, how is that debt on the real estate structured? Okay. First thing is this. What is a note? Okay. To make it very, very simple, you all deal in notes every single day. Okay. A dollar bill is a promissory note. It says it right on a dollar bill. If you write a check, that is a promissory note. So we deal in these things all of the time. Okay. But I'm going to show you how to get on the receiving side of that. So if we break it down to its most simplistic, a note is simply an IOU. Okay. From a borrower to a lender or an investor. That's all it is, right? So this would be a simple example as I can get of an IOU note. Somebody is borrowing money, right? So we got a borrower there. Somebody's borrowing it from a lender. So we have a lender there, right? Whoops. Got a lender here. You know, you all know this through money school. Nothing really major here. They're borrowing a certain amount at a certain interest rate, and they have to pay it back. And this one even has a thing. If you don't pay it back, then you got to pay for any collection or attorney fees. Okay. That's a simple note. Now, this would be an example of an unsecured note. If I lent you money, anybody, if I lent you money and you didn't pay me back, do I have any legal recourse to the law? Sure. If you don't pay me back, I can sue you. I can pursue you in court to get what? A judgment. Does a judgment mean I have money in my pocket now? No, it means I have a right to collect that from you. How I do that depends upon the type of judgment and debt that it is. So we don't buy just notes. So when people call it the note business, it's secondary, it's the secured note business. See, we buy notes that are secured, not notes where if the person doesn't pay, we have to take them to court. We have to sue them to try to collect our money. Our notes are backed by assets. And in particular, the asset is the property. Now, that might be vacant land, it might be a warehouse, might be a single family home, might be an apartment complex. Whatever it is, they're pledging that real estate as collateral for the loan. They're essentially saying, if I don't pay you back, you can have this land. Okay, you can have this building, you can have this home. They have to surrender that. Now, there may be a legal process involved, as we know, called foreclosure, but there may be other remedies as well. So an asset-backed note is an IOU from a borrower to a lender or an investor that is secured by collateral such as real estate. So the security agreement that comes along with buying a real estate note is, of course, the mortgage. Okay, so the mortgage is the security instrument. The mortgage is the one that pledges the real estate as collateral. So all of you who own homes right now, do you really own your home? Well, you do have ownership of the home, but if you borrowed money to buy that home, there is a lien on there. And if you don't pay back that loan, what are they going to do? They're going to enforce that security agreement. They're going to enforce that loan and take your property, either through a judicial or non-judicial foreclosure. That's what happens. Those are the documents that you sign at the closing. So when you borrow money, and again, it doesn't matter what type of money, if it's a short-term hard money loan, a bridge loan, a long-term mortgage from a bank or a private lender, whatever it is, you're signing two things. One, here's the terms, and here's the security agreement that says, if I don't pay you, here's what has to happen. So most of you are going to be very familiar with this. You're involved in money school or private money club, and you've learned obviously these concepts, plus your own personal experience here. So how does this play into an investment opportunity? Very simple. I'll break it down for you. We buy notes. The notes are backed by a security agreement. The security agreement is what binds that payback to the property. So the property is the collateral for that note. Pay us back, everything's good. If you don't pay us back, we enforce the agreement that you signed called a mortgage that allows us to pursue that collateral. It's as simple as that. That's what we buy. So that puts us in the position as a bank. Right? So one of the concepts they teach about in money school is be your own bank. This is another way to be your own bank, because when you buy the debt on the property, you become the note owner. Okay? You don't own the property, you're the note owner. You are the bank. Right? Just like if you borrowed money to buy your own home, you have a note owner called the bank and you're sending them money every single month. Right? Do you call the bank when you have a roof leak, a toilet overflow? No, the bank doesn't own your property. They just own the debt. They're the note owner. So in this concept, then instead of you making your payment to, let's say, Wells Fargo, you now make your payment to me. I'm the note owner. Okay. So that means that you're getting this monthly cash flow, okay, backed by the property. But again, the property owner owns the property. They're not a tenant of yours. So there's no management of the tenant. There's no maintenance of the property. That's up to the homeowner. We're the bank. Right? Wells Fargo doesn't come out and cut your lawn, doesn't fix your house up. You're the homeowner. You pay for all of that. No headaches with that. Okay. So the note owner gets the cash flow without all of those other items. Now, this is a type of investment that I know many of you with your life insurance policies, all these sorts of things, are more sensitive to and more educated on the difference between a tax sheltered account and a non-tax sheltered account. Well, this investment is approved for all of those tax sheltered accounts, for your IRAs, your 401ks, your Coverdell accounts. All of those sorts of things are all of the assets that you're able to, are all accounts that you're able to invest into these type of assets. Now, we do have a mediator on all of this. In almost every note that you buy, there'll be a servicing company. So the servicing company is the one that will collect the payments. They'll hold escrow, right? Because most people's mortgage payments, principal, interest, taxes, and insurance. right? So they'll collect all the money. They'll hold the tax insurance money in escrow. They'll pay those bills when those things are due. They'll send out any late notices, collect any late fees, those sorts of things. And they take out their $15 to $30 a month and they send the rest of the money on to you. Automatic. That's how it works. Okay. So in this case, you're truly being your own bank and collecting on all of those. Okay. So where do these notes all come from? We have a couple different sources on these notes. So as a note investor, we essentially have three different funnels of inventory that we tap into. One of them is banks. Okay. Now banks don't sell performing notes. Okay. They like to keep those. What they sell is non-performing notes. And what they typically will do is sell them to a larger company, a note investment company, we'll call it. And then that note investment company passes along those notes for sale down to individual note investors. Okay. RPL, NPL, reperforming loan, non-performing loan. So we get those from the banks. So once again, if banks are having more non-performing loans on their books because of new legislation, I'll just leave it at that. Because of new legislation, they don't foreclose on the majority of those notes. There's a small percentage they do, but the vast majority of those notes they sell as non-performing assets. They get them off their books. Okay. That fundamentally had changed with the Dodd-Frank Act, and you can look that up if you would like to. So banks now, instead of foreclosing, foreclosure rate's less than 1% right now. Okay, it's very, very low. When they start to build up these defaults or unrecognized debt, as some people call it, they'll start to sell those non-performing notes. So that's what I was saying, that if the economy does get worse and banks have to liquidate these assets, guess who they sell them to at a big discount? Us. That's why it gets better. Okay? That's why it gets better if the economy is worse. There's also REO investment companies, and some of you as small investors even have these things, right? You have a company, maybe you're just a company of one, or maybe you've raised capital from other investors and go out and buy real estate. And a popular business model is I'm going to buy the real estate, I'm going to sell it with financing, and then I've converted my investment from real property to paper. And I'm going to collect that monthly payment on the paper and eventually sell the paper. Okay, that's a very, very popular business model. And from those, we get performing loans, PL, reperforming loans, and non-performing loans as well. The other one is the mom and pop notes. There's a lot of mom and pop notes. I just did a presentation on this where I broke down all of the numbers from last year of how many mom and pop type of notes, seller finance notes, if you will, were created. And it's pretty interesting, but there's a high level of those notes. I don't have the numbers in front of me, but it's billions of dollars worth of these things that are created just on an individual basis. And a lot of those end up selling those notes down the road, and they come directly to us as well. So we have at any given time, we have these three different inventory funnels, if you will, that we can tap into. Okay. Now the spigot on the banknotes right now is pretty tight. It's a trickle. Why? Because there's not as many non-performing notes. Back in 2009 and 10, oh my gosh, that spigot was wide open because we had 10 million non-performing notes. Okay, so that will change. If the economy gets worse, that's going to open up. We're going to see more assets coming through there. And of course, more assets means more inventory, which means lower prices, which means higher yields for us as investors. Okay, and I'm keeping an eye on the Q&A there. So if you have anything, feel free to type them in. All right. So how quickly can someone get started and how much money do you need? Common question that I get. Take a look at this. And I always bring in new case studies because I'm very active every single day in this industry. And this was the latest one that I had here. So this investor came to me and again, no experience. Okay. Had heard about notes, started doing a little research online, found me, and we had a conversation. We talked about what he wanted to do, how I could help him in doing that. And we started working together, right? So he's been with me about 30 days. He wanted to get started right away. Not everybody does. He wanted to get started right away. And he had 3 sessions. What I mean by sessions, I work with people one-on-one for those who want to do that. And I set it up through Zoom like this so we can share screens and look at public records and everything else. So this is, again, I just wanted to pull these up to show you, to think of the timeline as I go through this. So May 10th was our first meeting, okay, together, Raghu and I. So we had a meeting on May 10th. We kind of outlined what he wanted to do, what his risk tolerance was. And all of you should think about on your own, what do you want to accomplish? You know, what kind of returns? What are your expectations? Are those real in the industry that you're looking at? What's your risk tolerance? How much time and effort are you going to invest in a particular area? Those sorts of things. And it's really important to have that lined up, because real estate financing, all these sorts of things, it's a big industry. Even notes is there's a lot of different ways you can go, just like in real estate. There's a lot of different ways you can go: single family, multifamily, industrial properties, wholesaling, retailing. I mean, rentals, there's a whole lot of different options. What's best for you? That's what you got to figure out. And it's the same thing in the note business. So I got a good feel about what he was looking for. I shaped it with him a little if his expectations were out of the reality of what can be produced in an industry. But it's important for you all to think about that yourselves as well, no matter which way you go as an investor here. So after that, I gave him some ideas of where to go and find inventory. So for example, PaperStack is one of the sources that I gave him. And I'll show you how that works and how it looks and everything else. It's a free site. You all can go there. I'll share that with you. There's no holding back on anything here for you. So I gave him a homework assignment. I said, okay, based upon this, here's where you're going to go. Here's what you're going to look for. Here's the ratios that you're looking for. Kick around a little bit and then schedule another call, which he did. So he scheduled, I said call, but it's a Zoom. So he scheduled another Zoom 3 days later. So now we've gone from May 10th to May 13th. So that's our second session. So in that second session, he kicked around on some of the deals that I showed, or that he found on PaperStack. And I had to correct him on some things, you know, that he just didn't get quite right the first time around. But again, this is brand new. That this is how people learn, right? I mean, you have to, go through and learn and go, have your coach come back or mentor come back and say, you got to do this a little bit more. You weren't looking at this thing properly. So the 3 notes that he had found right away, I was able to find the flaws within that and said, that's not really what you're looking to do. And here's why, right? Based on experience. I've done over 35 million transactions now. So I've got enough experience to come back and say, no, you don't want to do that. So I started going through with him. Okay. And this is a screenshot of what PaperStack looks like when you look at an asset here. So it gives you a little summary that you all can see. This is right from the site. The note seller, I own this note for over 3.5 years, and I have never had to talk to the borrowers. It's what we love, right? Never had to pay for their insurance or taxes. Their payment has always been on time, and they've been making extra principal payments all along. If they continue to make the extra principal and interest payments, the loan will be paid off early in August 2032. If they make the minimum required principal and interest payment, it'll be February 2023. The loan's serviced by FCI. That's a big servicing company out of California. And the servicing fee is $15 per month. Remember, I told you they're a servicing company. I'm selling the note to pay taxes on my Roth conversion. So he's personally, he's going through taking his IRA, converting to a Roth. He has to pay the taxes on that now. That way, later on, the money will come out tax-free, for those who don't know. You can see when this was listed, when I took this screenshot. So obviously the 10 days ago is going to change. But they were asking $31,250 for this note. It's in Georgia. Okay, it's occupied, owner-occupied property. It's in first position. It's a performing loan. It's done with a type of security agreement called a contract for deed. In brief, a contract for deed is another security agreement, just like a mortgage is, just like a deed of trust is. As somebody earlier said, hi from California. In California, they use deeds of trust out there. I'm in Florida. In Florida, we use mortgages. Okay, they're both security agreements. It's just how they are handled if someone does not perform. Okay, I'll leave it at that for now. The contract for deed is a type of arrangement where I'll say, I'll lend you the money, but I'm going to stay on the title to the property until you pay me in full. In the meantime, you have all of these rights, including the right of equity. Okay, but it's a more secure position for a note holder or a lender because they're on the title to the property until paid in full. And we all know possession is what? 9/10 of the law, right? 9/10 of the law. So here's what we have. We've got $33,850 is the unpaid balance, but you'll notice the price they're asking for is less than that. Okay, that's called a discount. So we're buying it at a discount. When we buy at a discount, our return goes up. In other words, this note is written at 10% interest. You can see it right there. If we were to pay $33,850.77 for this note, we would be making what? 10% interest per year. But if we're getting the same monthly payment, $451.95, and we're paying less than $33,850.07, what would happen to our return? It would be higher than 10% because we're getting the same cash flow for the same period of time, 117.92 months, basically 118 months, getting the same cash flow. We're just paying less for it. So we're getting a discount. So our return, our yield is going to be higher than 10%. Now I'll show you how to calculate that mathematically and everything, but that's how it works. The original balance was 51.5. This loan goes all the way back to 2010. So this borrower has been in the property 14 years. Do they have a vested interest in that property? Have they established equity in that property? Are they motivated to stay and pay in that property? These are all questions that we look at. You see, just like looking at a real estate deal, what I'm trying to weigh out here is what's my risk, what's my reward, what's working toward the value of this note, what's working against it. Okay, very simple concept there. So we look at the basic numbers. I run those through the financial calculator to calculate my investment to value ratio, which measures my risk. Remember, risk is first. Okay, now this property, according to Zillow, is worth $237,000. So when I measure my risk, I would say, okay, if I paid $31,250 and it's backed by a property worth $237,000, am I safe? So we call that an investment to value ratio. And again, I'll do the number anyway. I know you guys can see, know the answer, but if I invested $31,250 divided by a property that's worth, I think we said 270, I'm only in this thing for 12%, right? Because remember, if they don't pay us back, we foreclose on the collateral. Now that'll never happen in this case. They have way too much equity. If things went horribly wrong financially, they would sell the property, cash you out, and move on, and walk away with a bunch of money. Of course, okay? But I'm looking at that risk. I'm going, there's no risk in this one. There's virtually no risk in this one because the house is worth so much. You're in it for 12%. So we can check that risk box. See what I mean? So now it's a matter of, what about return? That's why we don't look at return first. We look at risk first, okay? And then I can look at my return. So my return on this one, I would calculate also, very simple math here. This is a financial calculator. I'm going to use these 4 variables here. And I'm going to say if I paid $31,250, that would be my present value that I'm investing in this note. And I'm getting back $451.95 of cash outflow. And I'm getting that for 100, I'm just going to round it up in 18 months. I'm going to solve for my interest per year. So that's the number of periods, number of payments I'm getting. That's how much I'm investing. And that's my monthly payment that I'm getting in return. All I do is click here and it tells me that's about a 12% return. So if I paid their asking price, I'm making 12% per year for the next 118 months. Okay. I'm safe, because I'm only in this thing where 12% of what the property of the collateral is, right? And I'm getting a discount. I'm not paying the full amount on this one, okay? So that's the basic math we look at. So this deal was good enough when I found it on PaperStack, working with Raghu, right? He's on his computer looking at the same numbers. I said, this is what you're looking for. Remember that first meeting we had? We talked about risk. This looks good so far, surface level due diligence. Then we started looking at, well, let's go to public records. So public records today, what? You jump online. You look on these things on the internet here, and we can see who the owners are. Okay, that's who he was buying it from. I can see that all the property taxes have been paid. That's important because property taxes in every state in the United States is a senior lien. It jumps ahead of all other liens and has the power to foreclose. A lot of people in the US, we kind of have this thought process of we own our property outright and we can do what we want. And yeah, no, not really. Stop paying your property taxes and find out how much you actually own that property. In a way, you're renting it, the land and such. Well, we won't get into that whole discussion, but yeah, you stop paying your property taxes, there's going to be a problem. They'll foreclose you for non-payment of property taxes, right? So we always look at that to see if they've paid. Here we can see a clear track record. This is all done in minutes, right? Online. I'm not traveling around. I'm not looking at property. We've probably been in the Zoom session together on this thing for 10 minutes. We're looking at public records already. I was able to see the sales history of the property. I can see that back in 2010, there was a foreclosure on the property. Then it looks like an investment company bought it. They had some trades here with a quick claim deed. Zero normally means it's an intra-company trade, and then it was sold for to this person for $43,000. Now, you can see that's all the same date, so they had corrective actions on these quick claim deeds. That's all that means. So I looked at that. I said, okay, that makes sense. The deed was clear here. It should be clean through these quick claim deeds. It went from this company over to that company for $43,000 back in 2020. Okay, so I'm seeing all of this. I haven't paid a dime. I'm just going through free public records and a free resource. Sales history gave me, like I said, the whole breakdown here. So this finance company, Finance Home Opportunity, they're the ones who bought the property. They fixed it up. They sold it. They created the note. Once they created the note, they sold it to Orange Capital. Orange Capital sold it to Integrity. Boom. I know all of this already. How? Through research. So then I instructed Raghu on that phone call. I said, okay, you need to contact the seller and get the following information. We need a loan payoff. And you can see this is a loan payoff right from the servicing company. And no late fees, no payments due, none of this bad stuff over here. This person's been paying on time. We can see that. And here's what the balance is right to that particular day. Boom, that looks good. What about the payment history? This is a truncated version of the payment history. They're not only paying on time, they're paying early. This date variance here, day variance, if it's a positive number, which they most normally are, that's when they're late. So they were 13 days late on this one back here in 2023 in September. This 2 days early, 17 days early, 3 days early, 18 days early. They're paying early. We're seeing all this before we've even made an offer, before we've agreed to buy it. You see, I don't have to drive out. And, if you're looking at a property, you're doing what? You're taking notes. What needs to be fixed? What needs to be done? This, that, and the other. Here, boom, right online. We're looking at everything. And then I said, here's all the documents that we need. We need to see the original security agreement, which in this case was the agreement for deed. They also created a note. So we're buying a note, okay, with a security agreement. So there's the original 2010 purchase money note for the $51,500. There's the agreement for deed, our security agreement here. And I can also see that that was assigned. Okay, we have these assignments of the notes. We have these quick claim deeds here. Able to see all of this. I can track the whole thing, make sure that everything was done properly. We call that, was it papered up properly or not? Okay. Looked at all of that. Now we were ready to make an offer. So I told Raghu, I said, this is a good one, man. I said, I know you're new to this. You want to get started early. I'm telling you right now, this is a good one. For all the reasons that I just outlined for you. It's papered up properly. The risk is extremely, extremely low. The reward is 12%. You've got a great seasoning on here. There's a ton of equity. You'll never have to foreclose on this thing because the guy would sell it for $270,000 and pay you off the loan, the 33 grand, walk away with a bunch of money. It'll never be a problem for you. And they're paying on time all the time. What more could you want? So he pulled the trigger. I said, get it under contract, subject to an acceptable BPO and title report. Because I know some of you, I mentioned Zillow, and there was probably a groan that I heard through the Zoom, even though I didn't hear you. Like, oh, Zillow. Right. We look at Zillow, we look at Realtor.com, we looked at Redfin. They were all in that 230, but he's brand new to the business. I said, make your offer subject to an acceptable BPO, title report, and further due diligence. Boom. Okay, so he ordered his BPO and title report, which cost about $180 in total, done in about 3 days, by the way, anywhere in the country, one phone call. So title report came back, no surprises. It showed all the same documents that we already saw on public records. We knew the whole thing already. Perfect. The BPO, guess what? Came in at $235. 30-day quick sale at $215. So this house value is absolutely there, verified third party, not interested. So boom, now we're ready to go. Now we're ready to go through a closing. Okay, the deal closed at the end of May. Here's the rundown. He purchased it for $31,000. So we got a little bit of a discount. They were asking 31, was it 250, something like that? So we got it for 31. So his yield's a 12% yield. 31 backed by a $230,000 property, again, puts him in at about 13% investment to value ratio, extremely low. What's he getting back? He's getting back 118 monthly payments of $451.95. Okay. And that gives him a 12.17 annualized return. So really a couple hours worth of work time, because we had to wait on BPO and everything else, but a true, when we just boil it down to how much work did we put into this, couple hours. Okay. Now, again, granted, he had the experience from me, but a couple hours, and he's going to get returns now for what is that? 10 years, 10 years worth of returns, right? Oh, no, it's not 10 years. 67, whatever. It's a seven, whatever that comes out to, 7, 8 years. 60 months would be 5, right? So whatever that comes out to, 6, 7 years worth of payments on about a couple hours worth of true effort. The rest was just waiting on BPOs and paperwork and such. Pretty interesting. So what about longer term results? So I showed you a quick one. What about longer term results here? Well, longer term through Chris, Alvin found me, and I love Alvin's story because, again, came to me with no experience. Learned a lot through Chris with the money school and such, but he was ready to go also. In 18 months, he's purchased 15 performing notes. They're all performing. They're averaging about 12% return. They're backed by assets more than 3 times what he's got in it. He's been utilizing his IRA and 401k, so most of those are going to be tax-free. And then he started saying, I want to get a little bit more aggressive and get into non-performing loans. And I said, okay, here's the deal with the non-performing loans. So we can buy performing loans, which are lower risk. We can buy non-performing loans. Now, non-performing loans, inherently, you're buying a broken product, right? It's like buying a rehab. It's you're going to fix it up. So what's the note going to cost us to fix it up? And what's it going to be worth after? Just like you'd be looking at a piece of real estate going, okay, I'm buying a fixer up here, but I put 30 grand into it and it's going to be worth substantially more. So he closed on that first non-performing note, by the way, but in 18 months of effort. Now, again, we could boil that down to not many hours, but just since he's been working with me 18 months, he's got 20 years worth of returns. The non-performing note that he bought, by the way, which he just closed on last month, I think it was, it's this property right here. And this property was vacant. We thought it might have been rented possibly, but it ended up being vacant. But the property owner, the debtor, was not living in the property. And he knew that going in. Unpaid balance of 30 grand. The payoff, when you added all the other late fees and everything else, was $37,000. Property was worth about $15,000. So one of the other things that you look at when you're buying notes, especially non-performing notes that are on vacant property, is you're going to foreclose in this. The owner's not even there. If they want to catch up, they can catch up. They have every opportunity. We'd love for them to do that. But if they don't, we know that this is going to foreclosure. The person basically abandoned this house. Okay. Nobody goes into this business wanting to foreclose on anybody. Certainly not Alvin. And I know nobody that wants to foreclose on people. I've never had to do it. I've had to threaten it. I say this all the time. I've had to threaten foreclosure a bunch of times because sometimes you got people who are going to sit in there and just try to stay for free forever. It doesn't happen. It's like sometimes you have to file foreclosure to wake them up. But in a case like this, where they've abandoned essentially this property, said, hey, I'll give, the guy wants to catch up, he can catch up. If he doesn't, we're going to pursue the property. Okay. So what did he buy this for? Well, the house is worth 50 as is. The UPB is 30,000, but the legal payoff is 37,000. When you buy non-performing assets, you buy at a deeper discount. He bought this for $16,500. How many of you would like to buy a $50,000 house for $16,500? I hope a lot of hands went up. This is also a contract for deed. So he's buying the contract for deed, which means he's going on to the title of the property when he buys the note. So all he has to do is a legal notification to the delinquent borrower saying, you either got to catch up on this within 60 days or all your rights have been surrendered and they're null and void. And that's eventually what happened. He went through the legal process and there you go. He's got the property. What's he going to do with the property? Whatever he wants. He could sell it at cash as is. He could sell it with financing, create his own note. He could fix it up and sell it with financing, anything he wants. The point being, is he going to make money on this deal? Sure. It's a matter of how much it went. Do you think we walked through 4 or 5 different scenarios before he bought it as to what he could do with it? Of course we did. So he's got plans in motion, and I'm sure he'll have something, an update on this story next month for me. Are your investments prepared for worst case scenario? I want to run through this with you all as well. Let me see if I have some questions here. effort. I think I'm answering those questions as I go through. How much money do you need to start in the business? What are the costs of these notes? So I'm giving you some examples through that. Let's see. Can you have a title company do their title due diligence if you'd like to? Yes, you can. Yes, you can. Because they'll do a title report for you, and the title report will give you a summary of the title, and then they give you all of the documents that they use to create that summary. Now, I would suggest to you though, before you get to that point, that you look on public records yourself and have an idea of what's on there. Because what you don't want to do, it's like almost like if you were going, I'll parallel this to going to an auction at a foreclosure. If you're getting BPOs on every property that you might bid on at the auction, at some point in time, you're just wasting money. So there are cases where you probably won't need to get a title report. Now, again, that's a little bit more advanced, but sure, you could have a title company and outsource that as well. Oh, you're most welcome. Most welcome. All right, cool. Are your investments prepared for worst case scenario? Again, I hope things don't go worst case scenario. I really do, but I'm also totally positioned. I don't have a single client. I think if property values drop 30%, I don't think I'd have a single client that'd be in trouble, meaning that they're in them for less money than that, and they'd still be protected on that. So worst case scenario, we have a market crash, we have property values go down, we have defaults increasing, those sorts of things. If anything, the last crash, note investors saved the day. The government tried to bail everybody out, didn't work. Wall Street tried to buy up a lot of properties, which they're still doing today. And they ran into property management problems the first time around. I think they figured that out, and that's why they're buying more properties again and renting them. Keeping people away from buying in a way. But we're good. We're totally good in a good market, but in a bad market, that's where we can buy these non-performing assets and help people stay in their homes. You see, the goal is not to foreclose on people, it's to give them a second chance. And again, on that note that I showed with Alvin, he paid 16.5. If this guy came up with, I forget what the number was, but let's just say it was 10 grand to catch up on his loan, Alvin would have said, fine, no problem. And then he would have been paying on that $31,000 balance, would have been great. He gave that person the opportunity to do that. They didn't have it. It's time, and they already left the property. It's time for them to move on. So we help people stay in their homes, because if we buy them cheap enough, we can do what banks cannot do or are not willing to do, which is work with people. If we buy them that cheap, can we stretch out a loan and lower the payments? Can we modify the interest rate? Can we take all this arrearage that they built up for non-payments for 2 years and just move it to the back of the loan? Say, forget, we're not going to foreclose on you for that. We'll move it to the back of the loan, start making payments again. There's all sorts of things that we can do. That's ultimately what we do to help out. And that's why we saved so many people from foreclosure last time around in 2008, 9, and 10. So the note industry, yeah, we have plenty of opportunities, even more opportunities if things get bad. Are they getting worse? Okay, I just pulled this yesterday for you all. This is, and I want to show you all these sources. So I'm not naming like just the news, sources. We're going right to the Federal Reserve Bank of New York. And you can see the household debt, which is all tracked. They look at that and look at the increases. So the non-household debt, you can kind of just visually see that that's been growing higher than even housing debt. But we know housing debt has been going up here. So they look at non-housing debt as those are the dominoes to fall first. When they start to see credit card debt go up and then the delinquencies on credit card debt go up, that's a troubling sign. That's followed by the next domino, which is auto debt. When they see auto debt go up and then they see delinquencies on auto debt to go up, guess what's next? Household debt. Those are the first dominoes that fall. So the troubling part here is this, that nearly 9% of credit card balances and 8% of auto loans are in delinquency. Now, that might seem like a small percent. It is a small percentage, but that's a huge, huge number. So we've seen our debt grow, very, very substantially lately, and it's troublesome. So you can see delinquencies increasing in cards for maxed out borrowers. The delinquency rate on automobiles is up, and then this hit the other day, June 2nd. I don't know how many people saw this news as well. That's a big number. Big number. In unrealized losses hit the U.S. banking system. FDIC says 63 lenders are on the brink of insolvency. Didn't make headline news. Astounds me. Did not even make headline news. Is this real? Is this just some magazine? Well, where'd they get their data? From the FDIC, quarterly banking profile, first quarter 2024. It's all right in there. All the charts, all the graphs, all those numbers. So we've got 63 banks. Now, what did they blame these unrealized losses on? Some of it is the securities that they hold that are maturing, which is T-bills and such that they bought, at lower interest rates that they have to sell at a deep discount to try to profit from. Why would somebody buy a low interest rate T-bond right now when they can buy new ones at 6-7%? So they're in trouble there, but also they note residential mortgages because people have been behind on their loans on paper, but it hasn't hit the news yet because the banks have kind of been absorbing it, hence the term unrealized losses. They haven't realized. It's kind of like a stock. If you own a stock and it goes down, you haven't lost money yet because you haven't sold your stock, but if you do, you've got a loss there. So they haven't realized the loss yet, but they're in trouble. And so what'll happen is these loans will come to the surface and they'll eventually be sold. And then that'll trickle down. You remember the funnel I was talking about, and that's going to land in front of us. Okay. Now there's programs here like the Homeowner Assistance Fund that we've been utilizing already. So think about this, the way this fund works in brief. You buy a non-performing note. They haven't made a payment in 2 years. And let's just say that balance is $20,000. Okay, I'm just totally picking a number. So that whatever, they've got a $100,000 loan, they own 20 grand. Just keep simple numbers. And they haven't made a payment. So in 2 years, 20,000 bucks, and they're in trouble. And you buy that non-performing note at a discount. So maybe you get that non-performing note for 30,000 bucks. Okay, they owe 100, you buy it for 30,000, something like that. You try to work with this person, you say, hey, there's a government program here called the Homeowner Assistance Fund. It was funded by $10 billion. Every state got money. And as you can see, some of them have already allocated that money. Oh, this one here, program closed. Some of them still have money. See, this program's been around for 2-3 years. I've been telling my clients about this for years. And what we do is we say, okay, you want to stay in your home. How do you stay in your home if you have a $20,000 arrearage account? We can accelerate the loan and go to foreclosure. No, what we do is we say, look, apply for this program. They will catch you up on your loan, and then we can modify if we need to modify. It takes about 60 days to get that money. So if you had that person apply, which is free, which can be done on the phone, can be done online, they get approved. The government, state government at this point, federal money given to the state government will pay you the $20,000 to catch them up on their loan. Now they still owe 100. You paid 30, you got $20,000 back. So now you have 10 grand in the deal. Could you modify that $100,000 loan? Okay, so that's pretty crazy, right? Now think about it this way too. Some of these states that have already allocated the money, if things go wrong, do you think in today's world, where everything is politicized, that whoever's in charge, if foreclosures, people in foreclosure, not the foreclosures, but people in the foreclosure process, if that starts to rise, do you think that they will put more money into this fund or just let people get foreclosed upon? Obviously, any party's going to put more money into this. They did the same thing. This program was called Hardest Hit Fund back in 2008. This is the revamped version of it. Rename it, make it yours. Okay, great. It's the same thing here. Okay, so just to give you an example, I trained this guy in the business maybe 15 years ago. He's done really well. He's out in Arizona. He bought this note. He had it for a while, and it had been paid on, and then got late, and I ran into some problems here. And at this point in time, he only had about $7,000 in this note, but she became behind. You can see he outlined everything that was owed to catch her up on the loan. So the effort was to keep her in her home. Well, to keep her in her home, it's going to cost $20,358. The state paid for that. It doesn't matter that he only had $7,000 in this note. They gave him $20,358. She got to stay in her home and start making payments again. Pretty neat, right? All right. Bankruptcies. Another troublesome sign. Bankruptcies are on the rise, 16% over previous year. Now, the ones we see in this business are Chapter 7 and Chapter 13. The biggest ones on there. You can see the increases. Okay. that's happening there. Again, another troublesome sign. Now, bankruptcies for most investors, they run the other way, right? If you're buying real estate, you don't want to deal with somebody in bankruptcy. Totally get it, because you're not in a favorable position in that bankruptcy. In the note business, we are. We actually seek out these notes. And by the way, this doesn't look nationwide, 187,000 in 2024. Now, again, you start to add all those numbers up per year, and that's a lot of loans, but there was only 11,000 plus. There was between 11 and 12,000 foreclosures in the entire United States last year. You can look that up as well. Okay, so put things in perspective. So we pursue these types of notes, 7 in the non-performing realm, 13s in the performing or reperforming realm. Why? Because of this, my favorite chapter 13 case study here. Mobile home. Again, a lot of people shy away from mobile homes. We'll change your thinking on some of these things. Reperforming note, mobile home, and there it is. It's way out in the middle of this 3 acres. Okay, and the 3 acres is also surrounded. You can see a bigger home towards the top there. It's surrounded by 12 acres, and there's a custom home on that. And it was the same borrower. How do we know that? Because we looked at public records. I said, well, that's interesting. So they have this one, and that went into bankruptcy. The surrounding acreage was not a part of that because of the way they have things structured on this, and that made it intriguing to me. Now, this one, I remember, you get a BPO on this and such, you can't see, you can't get a picture of this house or what it looks like other than from above. Now, again, today's world, they could probably fly a drone out there, but we just didn't do that in this particular case. Wasn't necessary. The BPO that came back was a picture of the gate, here along the road. There's a road that runs on the side here, but didn't need that. Nonetheless, bankruptcy chapter 13 had already been filed, and this person had already been approved. So their bankruptcy was approved. And the 13 is a reorganization of debt. So essentially what they do is they get rid of or heavily modify any unsecured debt, credit card debt, those sorts of things. And they focus on the loan on their house and typically a car. And that's it. How can we restructure what these people make? Because it doesn't mean they're not making any money. They're making a salary, but their debt's too high. Okay. So we can get rid of that other debt so they can afford to stay in their home and have a vehicle. So the plan was approved. The mobile home indeed was being rented at the time. The borrowers were following up on the bankruptcy plan. How do we know that? Because we looked at the plan. We looked at the plan before we bought it. Okay. And they were ahead on what's called the arrearage account. So what happens in a chapter 13 once it's been approved is this. They say, okay, so all your other debt's been erased. You still owe $77,000 on the mortgage and the note. You got to pay that back. Okay. And now that we've reduced your other debt, you can afford to do that. How do they know that? Because they had to submit all their financial records and the court had to approve it. Okay, great. Now, you also have $26,000 in an arrearage account. That's all those payments that you missed plus penalties and interest and everything else. You got to pay that back too. So on that arrearage account, we're just going to take that out of an amortization schedule and divide that by 5 years, 60 months. So you'll pay every single month for 60 months. We'll just take 26,000, divide it by 60, and that's your monthly payment. So my students come in and buy this note in this position. They're buying the $77,000 note with a $26,000 arrearage account. They paid $34,000 for the note. They got that for free. They paid $34,000 for the note. They got that for free. Why do we look for bankruptcy chapter 13? Because we like free. We like free. Okay? Let that sink in a little bit. What did they pay? They paid $34,000. How much money did they get back in the first year? All right. On the first year after they bought this note, on the reperforming note, on this $77,000 note, they received back $7,680. That's where the 12 payments on that loan. But they were also receiving money on the arrearage account, which was $13,961. So that's what, 21 grand they got back in the first year on a $34,000 investment. Okay, 60% return. That's just in the first year. What's going to happen in the next year? Well, the mortgage, because it's amortized, most of that money went towards principal. Now they owe $71,000. So they're still going to get the $7,100 or whatever it was. What was it? $7,600 in year two. And they're going to get the balance of the arrearage account, which is another $12,000. So in their second year, they've already got all of their money back, and they still have a note with probably a $68,000 balance. Good stuff. All right, early payoff, small turnkey note. Here's another small one for you. Land contract. Again, created back in 2015. We had nothing to do with it. We found this one through another source, and my student ended up buying this one for $14,996. He bought 114 payments. The property had gone up in value $8,000. He invested with his IRA $14,996. Is he safe? $15,000 backed by an $80,000 property. Sure. 14% yield on this one per year. It actually paid off in full in the 5th month. So what happens when a loan pays off in full? Your yield goes up. IRA, tax-free. This one, I'm going to do these real quick. This is Brian. Brian's probably got 22, 23 notes, and he's utilized his children's IRA to invest with him as a partner. Yes, you can do that. And he was a little bummed on this one being paid off. Bummed, but also, hey, great. I have to buy the other one. This one was paying pretty good. So nice looking property up in Taylor, South Carolina, $150,000, right? Nice, decent looking property. And $25,000 he invested in this thing September 23rd or 2023, but it just paid off February 2024. Right, so he only received 5 months on this one. He was hoping this would go long term because he was making a really good yield on this one. So he got 5 payments of $400 basically. So there's a couple grand there plus 29,000. So within 5 months, his $25,000 investment, he got back 31,160. He was making a 13% yield, but now that it paid off, you annualize it, make it a 55% yield on that as well. Never know when those are coming. Let's see how we do. Oh, we're doing great. Other ways that we work with people. Okay, so notes is not a one-trick pony. You can buy existing notes just like I've been showing you. From what price ranges? I mean, they can be anywhere from say 15,000. You'll see some at 10, but 15,000 up. No really upper limit. I could show you. I think I've got an example coming up of a couple 100,000 for those looking for bigger numbers. But you'll see a ton of notes at around the $35,000 price range and above, from there. So rehab property, seller finances. So one of the things we look at, remember I told you one of the funnels are these REO companies. Now it could be a company or an investor of one. Now again, we had nothing to do with this property at all at this point in time. So a real estate investor bought this property as a rehab. Great. They bought the property. You could see the numbers back here. This one's in Oklahoma. Who cares? That's one of the other things I work with people on. You go to where the opportunities are. Our marketplace is nationwide, but the bulk of these are probably going to be Midwest and Southeast, but you never have to go look at the property. You're not going out looking, driving around. You get a BPO. What's it worth? How hard is that today? Right? Go to where the deals are. So this in Oklahoma, let's see, $25,501. I don't know why the one on there, but you can see it right there on the loan. It was written at 8.5% interest. So the real estate investor who bought this property, fixed it up, sold it with financing to this borrower on a $25,000 note. They probably took a down payment. I'm sure it's in here somewhere. They wrote the note at 8.5% interest. They backed it by a mortgage, right? It's just a seller finance note from an investor. At some point in time, that investor wanted the cash out of the note. So they seasoned it, which means they collected payments to give it a payment history, right? That enhances the value of the note, okay? He bought it for $18,750, 11.33% yield. This borrower is actually paying ahead of time. So he's paying a little extra than he should, and that raised his yield to 14%. Little small note. We work with private lenders. This is Michael David, Private Money Club member. He's also a client of mine. He sold this condo with seller financing it. He seasoned it for a year. He created the note. You can see it was a 12% note, 5-year bridge loan, short-term loan. And he wanted to cash out of this note in year 2. And I decided to partner with a client of mine. We bought the note together. And so the note was $112,000, something like that, $114,000. And we bought that note. I partnered with a student of mine, and everything was disclosed. Everything, here's how we're going to split it, and everything else. And there's all the paperwork. And we closed on it back in 2022. So why do I bring that up? It's an older note. There's my company there, Pro Speak Productions. And why would I bring that up? Because same thing, it paid off. The guy was paying like clockwork. And then in 2024, they told us they're going to sell the property. Sure enough, on February 26th, we received a payoff. Partner made 12%. I made it just a little bit more at 13% when it closed. A lot of different ways to, again, to put this all together. This note, I'll get into a little creative aspect with you here. This is a note on land. Doesn't matter what it looks like. It's in this little town of Mulberry, Florida here. This is where the creative aspect comes in. So this person has a note, and what you'll see what's different about it is there's no payments made yet. They just created this in February. Okay, so when I was looking at this note, no payment history. $50,000, the person put $20,000 down. They created this $30,500 note for 120 months at 10%. You can see the breakdown there. So they were asking for an offer. So here's what I offered on this one with no payments yet. And there's the breakdown. I got creative on the financing, and I want to show you some crazy things about present value of notes here. So we've got a $30,500 note. Okay, so that's the present value of the note. It's written at 10% interest, and it was written for 120 payments. That's our number of payments. So the monthly payments of $403.06 will match right there. Okay, so that's what I'm faced with. They want an offer on this one. So with no payments, am I taking on more risk? Possibly. They put a pretty good down payment, right? 20 grand. But I got creative with this one. I said, here's what I'll do. How about I'll give you half of what you're asking for half of the payments. And then when I receive that, I want the right to buy the remaining half of the payments for the remaining balance. You with me? Okay. So instead of buying the whole note right now, where I would be taking on some more risk, right? I'd be in technically a $50,000 property for about 30 grand. I said, I'll give you half for half. Okay. So for 60 payments, I'll give you half of the 30,500, right? So I'm giving you your full asking price. So that means I'm going to pay $15,250 for half of the payments. Now watch what happens to my yield, 20%. Why would I buy the whole note and make 12 when I could buy half of the note, make 20%, and then I have the right to buy the remaining 60 payments at 15 grand. Plus I lowered my risk. I'm only in it for 15. It's worth 60. Fun with math. I know I went through that one a little quick. I want to get to some other examples here. Let's see, got rolling profit in there. Let me get to this. Buying these partials and such. I've got a little example. I'm going to go through the first part kind of quickly for you. Here's one strategy that a lot of people utilize. We call it stack in the back. You know, you're rolling the front and stacking the back as we call it here. So this is, again, another one just in Oklahoma. And you can see the numbers there. I'm going to move through this a little quickly. But essentially, my student paid $16,679 to receive 72 payments of $373 per month. That was his initial investment in this short-term note. He collected 3 payments, and then he sold the note to another investor at par. What par means is you're selling it for the full UPB, the full unpaid balance, because the note's already written at 11.25. So the investor buying the note at the unpaid balance is making, well, 11.25. So he sold that note. So his seed capital jumped up within 3 months to $19,000. Started with 16. Got it. Just took that money, what? Rolled it over. Because we have such a liquid marketplace, he took that money, bought a note the same month where he got 140 payments left. He paid $19,350 for that. So on that one, he collected 7 months of payment. Then instead of selling the whole note, he just sold 78 of the remaining payments, which left him 55 on the back end. That's called a partial. These are income streams for a long period of time. He just sold a certain number of payments, and then he'll get the payments back. It's called a partial. Very powerful technique. So now he's got $20,000 plus he's got in 78 months, he's got those payments coming back to him, right? So that's future money that he's built into this thing. But now he's got that 20 grand and do what? Buy another note, sell part of it, recapitalize, buy that note, stack the back. Stack the back, stack the back. Because you know what eventually happens is some of those notes pay off early. You've seen that established already. That's what brings the creative aspect in on a partial here. And I'll give you an example on the power of partial. So I even built a spreadsheet around this, by the way, and I'll show you how powerful this is. The IRS considers, they say to have a valid investment with your IRA, you have to invest at least $100. That's the minimum. That's why this is my $100 example here. So let's say you've got a note, okay? It's $100,000, $360. And I'll just say there's 260 payments left. We could do it that way. So you're going to come in and buy this note. Let's say you've got the right to buy this thing for $70,000. So you need $70,000 at the closing table. Maybe you want to do it creatively. Maybe you don't have the $70,000. So you have an investor say, you come to the table with $69,900 and we'll come in with 100. Yeah, the whole note there. So they're going to come in with 69.9, okay? And you're going to sell them 120 payments, let's say, okay? So you've got the right to buy all, whoops, this is 260, isn't it? Okay, so you've got the right to buy for $70,000 the next 260 payments. Okay, so you're going to have this investor come up with 69.9. They're going to get 120 of the 260 payments. So that leaves you with what? 140 on the back end. Okay, you're going to bring $100 to the table with your IRA. Doesn't have to be your IRA, but let's say it's your IRA. Let's say it's your kid's IRA, grandkid's IRA, whatever it is. Okay, they're going to come in with the $100. So that way we have our 70 grand at the closing. So what happens here is each party's entitled to something. So the entitlement I've lined out here. And what this is showing you, I'll make it a little bigger for you, is the black line is the loan over a period of time. That's for the entire length of the loan, the 260 months. And you'll notice the balance goes down every single month here, right? And the red line represents the partial that you sold to the other investors. So they're getting 120 payments for their 69.9. And then you would get all the remaining payments. Now, what might happen is, and we'll just say 5 years, the loan pays off. When the loan pays off, the balance of the loan is $90,536. That's what the payoff is on the loan, because most of what they've been paying is interest, not principal. Your partial investor receives 60 monthly payments. Now they're entitled to a payoff, but their payoff entitlement is $42,436. Okay, so just so you can hang with me on the math here, the full payoff is $90,536, but the partial investor is going to get $42,436 of that, meaning you're going to get back $48,100 on the payoff. How much did you have in it? $100. If it doesn't pay off early, now again, it could pay off any period of time here. You know, any period of time, you're making the difference between the red line and the black line at any point in time. Okay. Or we start getting all the payments back. And then you're getting, what did we say? You've got 100 and let's see. So there are originally 260 payments and you sold 120 of them. So you're entitled to 140 payments of $875.47 on your little $100 investment. And if they do pay it out over time, that's another $122,565 you've made on a $100 investment. That's where the advanced level comes in. So many people look at notes and go, yeah, what's the yield? 10, 12%. It's like, Yeah, if you just buy it off the shelf and don't do anything, if you get creative with it, if you understand the power of how the math works, because I'm showing you all the math, it's a game changer. Okay, it's a game changer because now your yields go, you can't even calculate that. You invested $100. Okay, now it doesn't have to be 100. You could put more money into the deal. You could actually wholesale deals. You could sell this note for 70,000. There's a lot of different things that you could do on that. I mean, basically, you could have this investor if you wanted to. You bring 72,000 to the table, okay, and now I'll give them 128 payments, whatever. So you pocket $2,000 at the closing, and you still got all the back payments. In that case, just a little less than you had before, right? Could structure it that way, and you're totally safe. That way, you didn't even put $100 in. You didn't put anything in. You basically presented the deal. They paid 72,000. They're happy with a 9% return. Essentially, they just get 128 months, and then you're in this position. The loan pays off early. I don't care where. 72 months, whatever that is. Loan payoff is 88. They're getting 40 of it. That's the power of partials. That's where the advanced techniques, all these sorts of things come into play. So could your IRA with $100 end up making 100 grand? How? I just showed you. Remember again, to attain financial freedom, one must either be a business owner, investor, or both, generating passive monthly income. And that's what we have in this. If you want to learn more about this, you want to work with me personally, write down that information. So there's my email and my Calendly link. So, feel free to schedule something, 30 minutes with me, and you just pick the date and the time, and we can do that. Pretty interesting. If you want a little bit more information about me and what I do, of course, you could ask anybody at Money Club, and there's some people who are already in my program, but I've got a variety of other programs. I've got just education only, those looking for that. I've got mentorship for those who want to personally work with me, like some of the examples I showed you with Raghu and with Alvin. Again, it's just you and I working on deals together, totally focused on you. And the way I do that is unlimited basis, by the way. And I have a partnership program as well. It's one of the new things I've been working with Steve on. So if you're interested in just the education, again, it's got 20 hours of education. It's the best in the industry, $795. If you're looking at true mentorship, which is working directly with me. Now, I don't outsource it. It's me personally. You schedule, you can see right there, it's unlimited. You schedule it, 1 hour sessions. If you want to book one every day, go ahead. You want to book one every week, go ahead. Every other week, whatever suits your schedule and your timeline of when you want to get going, that's what you schedule. And, no matter what skill you're learning, no matter what investment, I mean, when you think about it, how can you accelerate your learning? How can you minimize your mistakes and maximize your returns? Well, you got to work with somebody who's got experience. I don't care what it is, a sport, a new skill. That's the way people learn better, direct application on these things. And that's really what I offer on this. And I've got a lot of happy clients. And again, I'm very dedicated to that. Remember the philosophy that I said with Chris and Shauna and Steve and Tess and all the folks over at Money. They have invested. They want you to succeed. I do group sessions as well every other Wednesday. I do email support because I know sometimes people have 9 to 5 jobs and they're looking on the weekend. They're going, I guess I got to wait till next week. No, just shoot me an email. I'm like everybody else, right? Our phones don't leave our side. So a lot of times it's easier for me just to text you back. I do get first look assets. So I have a lot of companies that will come to me first before they sell their notes on PaperStack or any other forums. All the vendors, all the spreadsheets that I use, anything, all the blank documents. I mean, anything I use in the industry, it's all at your disposal at the mentorship level. And I wanted to price something that made sense. I wanted it to be affordable for everybody. So that's $3,900. If you're a busy person, you want to do this, but you don't have the time, you would rather have me find the deals based on what you're looking for. You want me to partner financially with you in the deal. That's a different level. That's the $15,000 program. But essentially, we meet. I figure out what you're looking for. I go pursue that. I present those to you. And if you like it, we end up partnering together on the deal. And I manage the whole thing. I get it boarded. I order the BPOs. I do basically everything with you. And that's at the $15,000 partnership level. And I get a question too, will you carry a note? Yeah. If you do want to finance it, that's a thing. You'd rather finance the $3,900 for the mentorship. You can do that. It's right on that same website. And it comes out to $716 a month. If you pay in full, it's $3,900. That's your discount. If you finance it at $716 per month, which puts you over the $3,900, I think it's $4,200 there. So the URL is on the bottom, but I did it this way as well. So that will take you to the page that outlines all of those in greater detail for those who may be interested in that. And if you just want to talk and see what other alternatives I might have for you, we can do that as well. So you don't have to buy something to talk to me. We'll talk and we'll figure out what I can do to help you and see if that's right for you. Let's see. So we might have some questions here. I know we're coming up on the end. I just saw a bunch of questions come in. The last example you showed, a short time investing, buying for 16, selling for 26 in a short time, as in a short time. Sorry, Efren, I don't really know what you're asking there, but I think I could blanket answer that, which is, these notes, you typically buy long-term, but if you want to sell short, you can do that. We have a pretty liquid marketplace. So if you bought a note and you decided a couple months later you wanted to sell that note, you could do that. Now, mathematically, we'd have to look at that and see, well, what price would that be at? And want to make sure that you make money in doing that. So we do have a liquid market where if you wanted to cash out, but in general, if you're looking for short term, you're probably looking at just making a wholesaling fee and maybe putting together a deal for another investor, making some money right on the top. You could also do things where you split payments. So maybe you go in with somebody, they get half the payment, you get half the payment, or 60-40, 70-30. There's a lot of different ways that can be structured as well. I hope that answered your question because I wasn't quite clear on that. Group teaching class. I do group coaching as a part of my mentorship. We do that every other Wednesday night. The thing is with group coaching, if that's all I did, I don't think my people would be getting the same results. I know they wouldn't get the same results because I couldn't dedicate enough time to everybody to do that. When I'm working one-on-one with you, the focus is totally on you and finding deals and that suit you. So it's programmed specifically to you. In a group coach, it's very hard to get into depth on that because what do? You have 40, 50 people on a call and you're trying to help everybody. It's not plausible to do that. But that's why I have the education part and then I have the consulting part to work together. What sort of time commitment typically goes into finding the right deals and knowing every situation? Well, you'll refine that skill and you'll refine that skill very quickly with me. And that's, and I should have mentioned your question triggered something else. The 3,900 covers everything, all the services, all the educational products that I have online for you for 6 months. After 6 months, it goes to $75 per month. That's all. So you just pay the $75 a month to maintain the services after 6 months. I've had people who've been with me for 5 years on that program. Why are they still on that program? Because they don't need me for the basics anymore. They don't need me to make offers. They know where to find the inventory. They know how to run their numbers. They know how to look at the documents now. But what they do is they keep me on retainer, if you will, $75 a month, for that unknown that comes up. A note goes bad, or the people declare bankruptcy, or they're looking on a new note or creating a new note and they need extra help. That's why they keep me on. And their education stays fresh. They get on the group calls and those sorts of things as well. But it takes me the way I broke it down is once you learn the couple of formulas, it'll take you 10 minutes literally to decide if a deal's worth looking at any further. And that's important because you don't want to go down a rabbit's hole on a deal to find out, oh, this one's no good. You'll know within 10 minutes if that deal's worth even going to public records. So it's done in stages. If you get to the public records and it looks good, then it's like, ooh, okay, let's get the documents, right? So just like in that first deal I was telling you about, there was literally maybe 3 hours of effort during the whole thing. And it was closed, within 30 days. I think it was like 20 something days from start to finding it to closing on it, so it can happen that quickly. It takes me, 15 minutes to go to public records and everything and be done. I'm well versed in it. So it might take you when you first started, I don't know, an hour just to double check everything, to look at one. Okay, great, super. Efron just said I answered it early in the presentation. Various levels of membership there. Again, it depends on what you're looking for. So again, if you just want to start with a phone call, you could do that. If you're looking at mentorship, which is the most popular, that's $3,900. I hope I answered everybody's question on that. Hope you guys learned a lot. And, again, there's a lot of avenues that you could do, but certainly, based on what you've seen, I would hope you at least explore looking at that. And again, I'm very open just to discussing, anything in the industry. It doesn't have to be related to anything that I'm offering, but for those interested in what I'm offering, it's, I'm dedicated to it. And I think that came through. All right, let's see. I don't know if Shauna probably had to go. So I don't see any other questions there. And I really enjoyed hosting this. I hope you guys enjoyed it too. If you did, let them know, because I love working with all of Chris's people from Private Money Club and BYOB and Money School and everything. I think he's doing some great things, and I'm really appreciative to be part of it. So thanks again, everybody, for your time and attention today, and look forward to speaking with you all, and wish everybody the best of luck. So thanks, everybody. Have a great rest of your day.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.